You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the Options Insider Radio Network for you, the busy financial advisor or asset manager who's out there trying to manage your clients' portfolios in these busy, nay, tumultuous markets. Maybe you need a little bit of help, especially when it comes to the options and volatility component of said portfolios. Maybe you want to learn a little bit more. Maybe you're also out there in the market for a financial advisor or asset manager. You want to know what skills they should be bringing to the table in these tumultuous times. Either way, we've got you covered here on the Advisor's Option. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting network upon which so many of us are just binging these days, coming off the hottest month in the 15-plus year history of the network. That is saying something. So a lot of folks are out there. They are learning about these options things. They have questions. Hey, who can blame them? We all do. In fact, it's that time of the year, listeners. Middle of the year, our mailbag has been filling up here for quite some time on the Advisor's Option. We will endeavor to clean it out at least as much as we can today by taking on all comers on the question front. And joining me to help tackle all of your many and varied queries in the world of options, my compatriot, my partner in all things Advisor's Options Crime, Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, even though we call him around these parts the Oracle of New Hampshire. We'll see how his Oracle is doing these days. Mr. Matt, welcome back to the program, sir.
Thank you. We are an RIA, so we are part of the clan here. And congratulations on so many people checking out the treasure trove at Option Insider, Mark.
It is quite the trove. A lot of digging to be done, and a lot of digging to be done on this episode. So let's get to it. Kick things off. A little bit of the old P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement, the segment, the portion of the show that was really born with the onset of the pandemic because so much crazy stuff was happening pretty much every episode. We had to kick things off talking about it. And now it is a segment we call the P&L statement, where we break down really what's going on in the current market environment, our thoughts on it. And there's a lot to be unpacked here. Mr. Matt, we just came off a pro Q&A with a guy you may know and love, or perhaps loathe, the Rock Lobster. He's your neighbor over there in Maine. And a lot of the questions coming at him, a lot of the questions we're getting these days right now are pretty much around, hey, what should I be doing with these levels in the S&P? Should I be buying? Should I be waiting for lower levels? In fact, we've had a lot of questions of the week about this. Very popular, very divisive with a lot of the audience, which, again, is understandable given where we are in the marketplace. You sent me an interesting message, I believe it was this time about a week ago. So level's not that dissimilar from where we are right back now that we're selling off again in the markets today, saying you thought all of your indicators were perhaps pointing to a bit of a bottom out there. Is that still the case, and what are you making of our current market environment, sir?
Well, this is no place for the timid. When I contacted you, we were about 365 or something on the SPY. And I go, you know what? This day was pretty good for our signals. And I mean, it was the bottom, but usually that's not when we get our signals turning around. And, I look at implied volatility, forward volatility relationships, and the contango of the SPY front months versus the back months. And it started, I go, Mark, this is looking positive. And we had a nice run up for, maybe a week. And then today or last night, we lost, this is kind of weird to say it this way, but we lost the forwards, which is saying one of our key things that we look at broke its uptrend, started coming down. And I said, uh-oh. So I told my trading club, we have an internal trading club at ORATS. And I said, this doesn't look good. And lo and behold, the market sold off. It was up 1% this morning and then down almost 3.5% from there. So it was quite a tumultuous day. And now all of the signals brethren have joined the kind of bearish turn. Implied volatility has popped up. Contango has fallen. So implied volatility has a negative relationship to the market. Contango has a positive relationship to the market. So when contango goes down, not so good. Our forward volatility relationship is when we look at flat forwards, which is making a theoretical forward versus the calculation of the forward volatility. I know that sounds a little funny, but we watch that pretty carefully. So that's all come down. So not good. Looking for new lows, Mark. I think it might even get down to the 350 range and SPY 340s range.
Oh, wow. So that's surprising. Because so we did do a lot of living since you sent me that prediction. We did bounce off that low. So in the near term, you were very much correct. But now it sounds like you are changing that a little bit. Interesting.
Yeah.
Wow.
Well, you got it. I mean, these signals are pretty quick. However, and you know what happened in our trading clubs? They go, why don't we look at these on a minute by minute basis? So right now, our tech team is busy doing some unbelievable work on the Amazon cloud to bring our users minute by minute signals. So, and we've looking at those. Usually they're near end of day is when we like to take the snapshot. That near end of days, reason that we do that is the markets tend to widen out at the very close. Reasons being that the market makers can't hedge effectively, so they'll often widen some markets out. Not as apparent in the SPY versus other stocks, but still important. So we look at it 14 minutes before the close going back. And now we're going to start looking at it a minute before the close. And so we'll talk about it later, but we're going to start sending that to you and our subscribers. And so it's going to be a lot of fun.
I like the idea of the ORATS Trading Club. I can see you and your like developers going back and forth with all the trading ideas. It sounds kind of fun. Maybe you need to open that up to the masses. The ORATS Trading Club.
Well, our all of our people. So from the beginning of my trading career, when I started hiring people, even if they were destined for an upstairs desk job, I put them on a badge, and they just were, starstruck or dumbstruck to be on the floor. But then you taste it, and then you could, when you're upstairs doing the statistics and the calculations and the programming, you have a better appreciation. So I always like to keep my people. I don't know how to say it a different way, but everyone at ORATS engaged in the market. I think it really helps and just shows from what they're coming up with. It's really collaborative and today we were talking about some of these way out of the money puts, and I talked about those a year ago with you. I got burned on a couple, so I stopped doing it. But so we're looking at now put spreads instead of just selling naked 70% down in Shopify puts or like bid. So I know they're going to split and stuff, but so we were talking about that today. We were talking about calendars and the SPX, so it was a lot of fun. So those are the things that we talk about at ORATS, Mark.
I love it. We'll have to get some of your people into our live chat. They could chat it up with our crazies here. It sounds like it'll be a fun time for everyone here. Speaking of our crazies in our audience, we asked you guys recently along the same lines. Over 40% of you guys said you were waiting. When we did a poll a few weeks ago, over 40% of you said you were waiting until S&P hit 3750, which was a level not that far away from where we were back in a little bit above where we were in the crazy pandemic era, beginning of it, the onset of it. Before starting to buy that dip was also where our next kind of technical support was hanging out in the S&P. At the time we posted that, we had hit that level and actually broken through, bound to Matt's bottom around the 36. I forgot how low in the 3,600 levels we got, but somewhere in that range. Are you guys buying back in or waiting for lower levels? And over half of our audience, Matt, 54.2%, said they are waiting for lower levels. Over a quarter, 25.4%, maybe a little bit disturbing, said they never got out. I mean, that could mean multiple things. Obviously, that could mean they were still actively trading. But I for this purposes, it means you're still riding down the S&P, which, hey, that's what we're here for, right? We'll help you get off. You can ride the elevator up. That's great. You don't want to ride it crashing back down. So hopefully listening to a show like this, you'll arm yourself with a few tools to help you at least slow the fall at the very least. And 20.3% saying you're back in. So you were back in at that 37.5 level, which, hey, we're still above that. So you're still looking good. But what are your own personal signals telling you out there, listeners? Hit us up. Let us know. Obviously, you guys have not been reticent to do that in our polls. So, Matt, what do you think? Half of our audience, over half, saying they're with you. They're waiting for lower levels at this point, sir.
Yeah, I mean, I think you have to be pretty tactical in this market. It is very difficult. I don't know if we were going to talk about hedges or not, but even hedging is difficult. That now we have the also not I have a lot of out of the money puts, but they were going down, and I'm like, what is going on? And skew just got whacked. Like I go, look at that slope. If you look at the put call slope, it is as cheap as it's ever been, and that's saying something, Mark. So basically, what ORATS, what we look at is the slope of the monthly, basically a weighted average of the monthly skew, and we usually communicate that it's like 9%, meaning every 10 deltas, the vol will be 9% more. It's kind of how the slope works, and that's what it's average. It's average 8-9% for the longest time. However, it is down in the 4s, and then I go, what is going on? And I look back, and there's no time back to 2007 when it's been this shallow. So people have their own measurements and such, but and my customers that I talk to about this are seeing the same thing. This is really so the skew really has flattened out, and so I said, okay, I'll sell some calls, buy some puts because I think it's going to turn around. Well, also what happens then is then you have to kind of buy stock to be delta neutral, and then what happens is the interest rates will get you. So the interest rates start to go up, and you lose money that way. So it's been a little challenging for my little strategy there. Probably should have done like a deep put spread or something vertical, but anyway, there's a lot to look out for now that we have interest rates sneaking back in. We have skew there. I think the interest rates have caused this skew to go down because again, when you want to profit from the implied interest rate in the market going up, you're going to be buying puts. Wait, am I saying that right? You want to get long stock, so you want to get short stock, so you'd be selling puts and buying calls. I always get confused. So in order to profit from interest rates going up, that's going to kind of take some of the skew out. So I think that's what's been happening. So long answer there, Mark, but I think it's an important one to consider when you're hedging and looking at staying in this market tactically.
That does line up with what we've been seeing on our options oddities program. We were talking recently about how there's tons of size revcons going up right now, and just tons, like across the board. So people are obviously looking to position their synthetics accordingly. If you don't have no idea what that means, listeners, don't worry. But it's a little bit deep in the weeds. But check out options oddities if you want to know more about all of that good stuff. Meanwhile, it's time for us to check out what lessons we've learned from the madness that is earnings season. It is time for the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the earnings volatility report.
All right, everybody, welcome to the earnings volatility report. Another segment that was birthed from the pandemic as we saw such madness unfolding in the markets as a result of earnings. A lot of it, the traditional analysis, the traditional volatility suppositions you might make going into an earnings announcement all went by the wayside with the onset of the pandemic. And we are all still living with the ramifications of that as a result. So we are coming at now the kind of the tail end, the dregs of the earnings season as we are waiting for the newest round of earnings to kind of kick in and commence there. But Mr. Matt, there's always some interesting learning and analysis to be done. You guys, as you mentioned, are always crunching the numbers over there in the land of ORATs. That said, we aren't completely done with earnings. There are still some big names you've heard of like General Mills and Nike, and my favorite name in all of the market, the Walgreens Boots Alliance. It sounds like it's straight out of Star Trek. They're all still popping off this week. So there are still some names popping off. But Mr. Matt, as we mentioned on the last show, we kind of came in pretty much right below the average we've been seeing for the last few years out there from an earnings vol perspective. I think we came in at 83%. The average is around 88%. So what are some of the interesting takeaways that you and your team have had as you've been crunching the numbers for earnings for the past cycle and for the names that are continuing to pop off right now?
Yeah, you got it, Mark. So as the listeners probably know, we look at earnings season and especially the number of weeks, 6 weeks that we break it down to. There's the earnings season traditionally starts about 2 weeks after quarter end. So quarter end is in 2 days. So in 2 weeks, it all starts over again. So we got mid-January, mid-April, mid-July, which is upcoming, and mid-October. And that's exactly what we do, Mark. We track each week. We average, what the implied earnings move is. So let's talk about the implied earnings move. So you look at the straddle of the front month, and usually that's going to point to what the market expects, how much the movement's going to be. We have a way to isolate just what's on the day of earnings. If there's only 1 day to expiration, that's easy. But if there's a week, 2 weeks to expiration, you have to apply a different set of distribution assumptions in order to value that what's going to be left over in the straddle. So we have a good method of looking at that, and then we isolate what the implied move is. We look at the past earnings moves, and then when they announce, we look at the actual move, and we do these comparisons. And like you say, the average has been about 88, 90%. meaning if you buy the straddle, you're already giving away 10%, 12%. But we've seen really bad results for straddle owners, especially over the pandemic. And now in this increased volatility, what tends to happen is the earnings tend to get blown up and they don't tend to move as much. People don't pay as much attention. They're more macro events than micro events is what we've normally seen. But in this last earnings, we saw incredibly high implied moves and not nearly the actual earnings moves that would pay for those. So, and then we always look at what the performance is in the first week, which is usually not so good. Second week, not as bad. Third week and fourth week are usually the best ones, and then tailing off fifth and sixth week tend to be all over the place. So those are the important things that we're looking at in earnings. Of course, you encouraged us to come out with this report, which is great. And now what we're doing, Mark, I sent you a sample, but we're going to start doing at least one earnings report a day, isolating a stock where we'll look at the past earnings. We'll look at it from a graphical perspective. We'll then go in and look at some trades that might fit the skew and the forecast versus what the expectations are, and then kind of show the distributions and show a bunch of information on neutral strategies. Nothing like unlimited loss strategies, but more like calendars and such. So we're going to start putting that out as both a video and in blog format. So we've come up with a automated system. It's really cool. I won't bore the users how we did it, but so we could get out a bunch of content, really killer content, and highlight what we know about these stocks. So that's how we're going to start looking at earnings season. And you mentioned General Foods. We're going to come out with them, and then you mentioned Walgreens. So I'm going to have to override that to get in, because we usually just look for the most liquid stock. So we might just have to do that for you, Mark. I know you hold that one near and dear to your heart. It is
just a fun name to say, the Walgreens Boots Alliance. It sounds like the Romulan Alliance is coming for you.
Yeah. Star Trek. Star Wars-esque. A lot of, we're in the dog days of earnings, so not a whole lot. We've highlighted Nike, we've highlighted Oracle and such. We'll do General Foods. But really when, mid-July is when this really starts popping up. We might have multiple videos and blogs per day. So go over to blog.orats.com if you want to get those. We sign up and you'll get a notification when we put them up. Or, of course, Option Insider, and go to your blog, Mark, and you'll be able to see it there. Hopefully, if you guys put it up, it'll be there.
It's all there, along with the earnings trades reports. We are currently still monitoring 92 long straddles, 42 short straddles, and 95 long calendars. Any interesting insights or nuggets from those as you've been tracking those trades, Matt?
Yeah, so we trade in before earnings, trade out after earnings, and we just follow how the trading has done. So the big winner is the long calendar, and that's that's pretty good, 1% on average. Oh wow, it's actually caught what it was in sample. The out of sample has now caught the in sample. That's a new development. So basically what we do is we have gone back and back tested the best time to put on calendars. And then we also track them by their week. So how many, how the calendars have done in each week. We track that, and we track the in-sample testing versus the out-of-sample testing. It looks like it's tracking right now, so that's great. So so we're happy with the way, especially the calendars have performed. We did track short straddles and long straddles and short calendars, but those never come up. But and those haven't been tracking as well nor doing as well. So we're liking the calendars in that and the trades around earnings, and so do a lot of the people that have traded earnings for a long time. They like to look at those types of trades too. So it's been interesting to follow. What we do in this report is we'll say, hey, these are the signals to look at today, and then we'll show you how it did the next day. So that's fun to look at too. So yeah, check it out on your blog, Mark.
And what else is also fun to get, listeners, is a little bit of the old buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to the buzz. And again, we're going to get to your questions in a second. First, let's get the buzz here and the big story, the ongoing debate. Can the party, just the explosion of options volume, can it continue into the teeth of what is now an aggressive bear market? Are we heading into recession? These are all questions that are lingering every time we do the show. And we have the most recent numbers from our friends at OCC for May. We'll be coming up in a couple of days. We'll have June as well, so hopefully that'll give us even more insight. But the answer for May was still a resounding yes. May was up nearly 20% from May of 2021. As you'll recall, May of 2021 was no slouch. We were kind of kicking off the second leg of the meme stock explosion there. Everyone and their mother and their mother's sister's brother were all out buying calls in May of last year. And this May exceeded it by nearly 20%. Overall volume was 866.5 million contracts. And even more interestingly, ADV through the end of May, so average daily volume, listeners, was 41.7 million contracts, up a whopping 6% from this time last year, which also means that if we can keep that pace throughout the rest of the year, we're going to beat last year's nearly 10 billion contracts by about 6%. So that would be no slouch of a year either out there. A few other highlights. ETF options kind of just blowing the doors off in May, up 44, nearly 45% from the year before. And index options, they've kind of been languishing. You know, a lot of the action was on single names. Index options haven't been doing as robust numbers as the single names, and index options were up 31.4% from May of 2021. So a lot to sink your teeth into out there. If you are out there crunching the numbers, if you do have a vote, if you vote in one of our many polls about will the options volume party continue? Mr. Matt, yet another data point in the will the party continue saga. So far, the answer seems like it's yes. What are your thoughts, sir?
Yeah, I mean, there's some interesting data there. So, the YOLO that's the only thing that's gone down. The single name equity options have gone down. ETF has just been screaming. I think that's a lot of SPY. I think it's a lot of people now are getting better technology, and the markets are so tight, they're just trading around. And you know, index options, there's a lot more of the shorter term strategies. People have been coming to us a lot for those zero DTEs. And now that the SPX has added everyday options, it's been pretty exciting. And I think that's showing in their numbers. So, you know me, Mark, I always say that the bear market's not usually good for, unless you get a lot of volatility. But a dragging down bear market usually isn't that great for option trading. And when the Fed's tightening, not so great, but it's still going against those two things. So I don't think we'll catch last year, but I've been wrong before on this. So this is you don't have to put any money by this, but this isn't trading. This is just wondering how many trades are going to happen. It's tough to bet against the tide of options trading. With so much great work being done out there in education and data and so much technology making this all possible. But, also the Fed, if they're going to do some tightening, and that it usually doesn't bode well for options when that happens, Mark.
You're right. The setups are not favorable, and yet I've voted against the volume train before, and I've been proven wrong. The skeptic in me have been proven wrong, so I've had that beaten out of me. So who am I to second guess the legion of newcomers, new listeners? Hey, hottest month in the history of the network last month. So lot of indicators are pointing down, but also others are pointing to continued interest in this area and this product. We have a lot of new people who have joined the space since, not just even since the pandemic, but just in the last 6 months. So this is a very different ball game than it was in any previous kind of big sell-off or bear market where we have so many new retail investors joining the party out there. Will that keep us aloft? Will that buoy us in troubled times? We shall find out. What is your vote out there, listeners? So far, the answer has still remained yes. We are pretty much halfway through the year or coming up on it. And so far, the answer is still yes, which is, I suppose, good for all you options bulls, which at the end of the day, we all are. We all want volume to continue to go up. We all want this rising tide to lift all boats. I think some of us are a little bit cynical, but hey, crazier things have happened out there. You know what's never crazy, listeners? It's your mail. You guys have been hitting us up like crazy all year long. We always try to get to some of you, but let's get to as many of you as we can today. It's our mid-year mailbag palooza, and it starts right now.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. You know what? If you don't like waiting for your question to be answered on the advisor's option, I get it. The show is only once a month. If you want to bump yourself up to the top of the list, join the rest of our listeners here in the live chat. Go to theoptionsinsider.com/pro. You always get bumped to the top of the list. Then, just like our listener today, Nichols, who's listening live, he wants to know, Mr. Matt, are you still trading BITO here, a.k.a. the ProShares Bitcoin ETF, Mr. Matt? I know you were slinging it for a while. You still trading some BITO?
Oh, yeah. So I have long Bitcoin, and so I did the sell, call, buy, put in BITO. Worked out great. And then it got so low that I can't go any lower. So I started buying it, and then that hasn't been doing too well. But there's still time. So, but yes, still trading BITO. I like it. Again, I think, we talked about the correlation on a show a few shows back. And the correlation is pretty good for BITO. And also the bleed isn't too bad. The futures aren't, the contango isn't that bad. So yeah, I've been enjoying a bit of my BITO.
Enjoying the old BITO. Yeah, I've had a lot of my reticence to recommend that one beaten out of me because I was with you. I was worried about the drag and the correlation early on. And we have seen now that we have a few months under our belt. The correlation is pretty good. The drag is not that bad. Also, the benefits outweigh some of those drawbacks, which are, of course, you can trade options on this thing. You can't really do that on a lot of the other ETFs, or I should say a lot of the other Bitcoin vehicles out there. So if the options are a key driver for you and you're listening to a show like this, then they probably are. The fact that you could collar BITO, you can write calls against it, you can hedge it with puts, all the things we talk about here on this show. If that intrigues you, then you can do a heck of a lot worse than BITO right now. So yeah, interesting stuff. I'm not in it right now, but I do like these levels. I am starting to get intrigued out there. I mostly had my crypto in a bunch of pretty much everything but Bitcoin. But with BITO at these levels, I may have to start doing a little bit of the old nibbling as well, maybe selling some puts out there, which is not a trade that usually was very favorable in crypto. The skew was not that favorable for it, but we have seen a lot of downside, and that skew did get pretty bit up. It has come in a bit now, but still intriguing things. That type of trade is more viable now than it was certainly when BITO launched and all the premium was to the calls out there. All right, good question there, Nichols. If you want to join all of our listeners there, get your stuff bumped to the top of not just this show, every show we do on the network. theoptionsinsider.com/pro is the place to go. Next up, we have Ellen. She wants to know, how would you recommend advisors approach these markets right now utilizing options? Is it better to be long SPY right now with a put for downside protection and look to capture the upside movement? Or should we be selling puts at farther out of the money strikes here, perhaps at 300 SPY? Oh, she's getting down there. And looking to generate income and buy in at lower levels. Mr. Matt, given everything we said at the top of the show, I have a feeling I know how you're going to lean. But what do you have to say here for Ellen wants to know, should she be long SPY with the put in her back pocket, or should she be looking maybe at identifying some lower levels where she wants to get in and start selling some puts?
Yeah, I mean, during the bull market, I was more on the long SPY and have some puts so you could buy more. And now I'm not so much like that. I'm more of the opinion that you should lighten up and sell puts when there's blood in the water. Meaning, if we get a good correction down to, I think 3,600, 3,500, that's when I'd look at selling some. You could really get some good premiums. And I would sell put spreads. We were looking at put spreads today, and it just, you could get more by selling just a straight put, but I never think it's worth it as far as just how much it's going to affect your sleep at night and just your margin and your so I would just buy a small put with it, sell one, buy one, wait till there's blood in the water going down. That's kind of the strategy that I'm thinking about. Let me just make one more comment on BITO. The skew market has now come up to the highest level. So meaning the puts are actually pretty high now. So there is some put skew to it. So it's pretty interesting. So I just wanted to add that in, Mark.
Yeah, BITO's been leaning negative on the skew side for a while. It's been kind of fascinating to see how they got really dire back not too long ago, a couple weeks ago on the show, in the teeth of the big sell-off. We've seen kind of some of the craziest downside skew we've seen out there since we started doing that show. So certainly intriguing stuff there. And as for the puts, I'm definitely down with selling some puts out there. Definitely, when the blood's in the water, you can definitely get some nice premium. And Matt's right. If you value sleeping at night, which a lot of people do, even if you do want to buy the S&P at those levels, buying that put could still help you in case, it's the old catch a falling knife scenario. You're never going to be exactly right with where the S&P bottoms out. If it blows aggressively through your strike and maybe you decide you don't want the S&P anymore, or maybe, again, you just want to free up some capital. People always forget there's no free lunch with these trades. If you sell a put, and even if you're going to get it, you go longer term, you go decently far out, you get, let's say 7-8%, sell a put. That sounds great. That's fantastic. I made the year's worth of equity return just by selling this put. But of course, you're tying up a lot of capital to do that too. So if you want to free up some capital, or as Matt mentioned, the thing you can't quantify, but if you want to sleep better at night, then buying that other put against it, it's going to take away some of that return, but also how do you quantify being able to sleep at night, right? That's the mystical factor in the advisor's option land. Good question there. Who was that? Ellen. Next up, we've got, I like this handle, C Nation 76. Is he just a patriot? Or 1776? Is he a John Cena fan, the C Nation? I didn't. Let us know what you're up to, C Nation 76. But he wants to know, why are zero cost collars considered to be suboptimal on this program? I've utilized that to great effect over the years and continue to benefit from them in this current market turmoil. Well, yeah, we have said that in the past. And hey, if you're working for you, that's great. I don't mean to slam them. I'm just saying from a setup perspective, if your goal at the outset is solely to negate your premium outlay, so it's a zero cost collar, the collar is never going to be optimal. You're always making some sacrifice to make things line up. You're going to buy a put maybe farther out of the money than you would like because you want the premium to line up, or you're going to have to sell a call closer to the at the money than perhaps you're comfortable with or initially wanted to do to make the premiums line up. So from that perspective, a zero cost collar is never optimal. We've talked about it on the past. There have been a lot of studies done on this. Nothing recently. I'd like to see them update this over there at OCC, but they did a great study called Collaring the Qs. They then updated it to look at collaring across a broad array of assets, not just equities, but precious metals and all sorts of different categories. We've talked about it before. You can still find it over there on the OCC website if you want to see it. And they messed around with different setups, and they found that pushing the put out and then driving the short call element closer to expiration. So certainly in the monthlies, and very much perhaps even in the weeklies. Now, that's another reason I like them to update this. They haven't really updated this study since the weeklies have exploded. That might be an interesting way to do it. Then that's a lot more work, obviously, for the advisor. Then you're selling calls on maybe a weekly basis, and rolling them and have a put out at least 6 months. That was usually the time frame they liked. They found that to be the sweet spot between theta decay and paying too much premium for your protection. They found doing it that way was far more optimal over time than any sort of zero cost setup. But hey, if you want to keep things simple and keep them in the same expiration month and you don't want to pay for it, I could certainly see the attraction of a zero cost collar. I'm just from a strictly technical perspective, it is always going to be less optimal than doing it some of the other ways we have talked about. Matt, I'm sure you have a lot to say on this scenario. I mean, after all, collars, I've said it before, they are kind of the holy grail for advisors. They give them everything they want, protection and income. Just a question of how they set them up. What do you have to say here for C Nation, who wants to know why we think zero cost collars are suboptimal?
Yeah, I mean, like you say, the benefits of them is easy to understand, and you know what you've outlaid, nothing. But the drawbacks are there's most likely if you have a pretty good scanner like most people have, like of course we have at ORATs, you're going to find calls that are better than other calls to sell. If you're doing back tests, you're going to find systematic strategies that are better than other, than tying yourself to a zero cost collar. Puts buying, I agree with that. I even go farther out than that, and I have a whole system of very far, not so far, and so I love having the far outs. The Vega kicks in and such. So I don't like to tie myself down with a zero, just the benefit of just having a zero cost and the benefit of just having understandable. I like to find calls that have that work for my outlook on the market, and hedge your happiness. So where is how are you going to feel if it goes here? How are you going to feel if it goes here? If you're selling these calls and just matching the puts, you're going to probably get too close and give away a lot of the reason that you have for owning the stock. So, again, there's good points and bad points. I just feel like if you're going to do a collar, there's more. There are better ways to look at it, Mark.
Yeah, maybe C Nation, you consider the zero cost collars maybe like a good starter collar. If you're just getting your feet wet with these options things, that's a good way maybe to start because it doesn't cost you anything and you can get a feel for how it works. And then over time, as you get a little bit more familiar with what the different moving parts are of a collar, and you look at some of the data we've talked about, you can check out what Matt has over there at orats.com. And then maybe you start to come to a different conclusion. You start playing with the different moving parts of the collar, and you could see why we say that. But hey, no offense meant, C Nation. It's just from a strictly technical perspective. There are better ways that it can be done, but they're going to cost you some money. So that's the trade-off there. All right, let's go out to here. We have, I think it's because we did that deep dive on BITO recently on the show, Matt. We're getting a lot of crypto questions, and you've talked about crypto a lot on the show in the past too. So you're becoming one of the crypto question people on the network here for people. We got a couple that are related. Maybe we'll just put these together. First, we'll go to Mackenzie. She's one of our diehard crypto enthusiasts here on the pro side. She wants to know, or she says, great episode on advisors and crypto last month. This obviously came in a few months back when we did that episode all things BITO. What do Mark and Matt and guest think about the algorithmic stablecoins that melted down since the last episode? Luna wiped over 100 billion off the board in market cap. These products were marketed around their stability. Turns out that was not the case. What are your thoughts on these products and their impact on crypto adoption by advisors? Oh, there we go. And we have a related comment, I guess, from Terry. Terry says, if Elizabeth Warren needed an argument for keeping crypto out of retirement accounts, she got it with Luna UST Apocalypse. I'm sure the folks at Fidelity were not happy about that one. Yeah, that was the reason we discussed crypto on the show a few months back, was that Fidelity kind of opened the kimono to 401ks having Bitcoin in them. And then, of course, that set off a heated debate. As I mentioned, Elizabeth Warren and others had to weigh in with their 2 cents. And but, of course, driving a lot of this controversy was the meltdown that Mackenzie mentioned. Luna, just madness, taking a lot of money off the boards, which, of course, if advisors were perhaps skittish or reticent about diving into crypto, they thought maybe it was a bit of the Wild West. That certainly didn't do anything to reassure them. If anything, it reinforced those fears. So, yeah, that was certainly interesting. Matt, you and I haven't really had a chance to talk about that big meltdown. What were your thoughts on that whole Luna debacle? And as Mackenzie and Terry put it, what do you think the impact's going to be on advisors and their usage now of all that has unfolded?
Yeah, I had heard of Terra and the problems with Terra for a long time before this. And, what people were saying was Terra is inflating the cost or the price of Bitcoin, and they didn't have the assets that there was some fraud that looked like. And so, I don't know. I'm disappointed with all this. As you know, I have got some ambivalence towards Bitcoin. I like it, a lot of things, but unfortunately, you can't get too caught up in it because the government is so strong right now that they could, and they're going to come out with their own digital currency. So you have to be really careful with Bitcoin. It's not going to be the end all and be all. I just listened to a book called The Fiat Standard. There's also the Bitcoin Standard. If anyone wants to dive deeper into this, the Fiat Standard, Seyfedin Amos is the, probably butchered that name, but really prolific, right? A great, really interesting book. Again, he's very much of a Bitcoin bull, but I've just seen what a lot of what's happened recently has to do with these algorithmic stable coins collapsing, but also just about turning Bitcoin is it going to be turned into a commodity? Are they going to tax every single transaction as a capital gain? It's just going to make it a pain in the ass to trade. They could do all these things. So, I think all those together are really weighing on Bitcoin. I think longer term, I'm still going to hold a piece of my portfolio, 5-10%, something like that. So I'm, getting more now when it's lower, but, again, I'm not a huge Bitcoin bull because of these, all this crap that's going on around it, like stable coins. I just you just shake your head. You go like, why does this have to be like this? Why do they have to do these stupid things around Bitcoin? And, why does the government have to do these stupid things? It would be such a great thing to not have all this fiat around. And in that fiat standard, they talk about all the bad things that happen, the savings rates and the health even of people. So it's a really interesting take on it, which I agree with those takes. But it's hard to be totally bullish on something that it competes with the government, and the government's so strong, as everyone well knows. So it's a tough one, Mark.
You're saying you're going to get long FedCoin when they launch that. That's what you're waiting for. If I can read between the lines there. Loading up all the FedCoin Matt can buy. That's what he's saying here. Next up, we have a question. I guess we'll have to hold on to this for the next time Mr. John joins us because Atticus wants to know, now that Fidelity is offering Bitcoin and IRA accounts, does Northern plan to follow suit with something similar? Obviously, Matt and I don't know. We'll have to get the specifics from Mr. John. He's been obviously very busy over there. He's been planning to join us a few times here on the show recently. We'll get him back on soon, and I will put your question to him, Atticus. I'd have to say, given what I know of Northern, that the answer is probably no. Adopting the latest bleeding edge financial trend is not their thing. It took them a while to even come around to options. That's what John and his team are kind of doing over there now. But we'll see. Maybe things are changing over there. So we'll put your question, Atticus, to him the next time John joins us here. John Cherry from Northern. All right, let's go out here to, this is an interesting question. This one's been hanging out in our mailbag for a while as well. Anthony Smith wants to know, can you guys discuss the role that annuities should play in client portfolios? Should advisors ever use these things, or are they really more like poor man's options? Yeah, I've called them that before for a variety of reasons. He also sent a link to a study. I forgot when this question came in. It was at least a few months ago. But this study is called, the article is called Study Finds Guaranteed Income for Life is more popular than annuities. Yeah, I guess if you couch it like that, people are going to be all hyped up to buy annuities. Morningstar did some research on this, and I guess they asked the same question about a hypothetical product, but they kept changing the name, and they got different results. When they asked someone if they wanted to buy effectively an annuity, they said, no, I don't want to touch those. But if they wanted to buy guaranteed income stream for life, then they responded more favorably. So yeah, go figure. They found that people are more willing to use their 401k to purchase a guaranteed income stream for life rather than an annuity. The thought of running out of money in retirement increases preferences for deferred over immediate annuities. They asked about 1,100 people who are working. That's the methodology of this study. So yeah, maybe we should start with, before we even get into the study, Mr. Matt, our thoughts on annuities. I think I've made it clear on the network in the past, I'm not a huge fan of these quote unquote, these guaranteed income streams. They achieve these in a lot of different ways. And oftentimes they could utilize derivatives to achieve that income stream. And you may or may not be aware of that. So people out there who think they have no exposure to derivatives actually do because of annuities. And so that's something you should definitely, very much a caveat emptor with annuities. You should look into how they are constructing and delivering that income stream. Oftentimes you can do it yourself using options and perhaps as we're getting back to the zero cost collar, there are optimal and suboptimal ways to do these things. And annuities are definitely always going to be suboptimal to creating that type of income stream yourself, but that requires more work, a little bit more sophistication, and a little bit more knowledge. It's easier to just buy a annuity, have someone else do it for you. So I could see why there's still a market for these things. Mr. Matt, what are your thoughts on annuities? A lot of advisors obviously like these things. Are you in that camp? And then what are your thoughts about this study that Anthony sent us, that if you call them guaranteed income for life, people like them better?
All right, Mark. So I'm gonna cause a little controversy here. So
I'm here for it. Let's go. Let's dance. Let's fight verbally
I went
over the network here.
Graduate school in Chicago for finance. I CPA, passed first test of CFA. And, no one likes annuities and those, but I actually think they can be very good for some people. Me, for
fighting
example,
fighting words. I like it.
Yeah. So, I'm a little unorganized and I don't have I've got so many things going. I'm running a business. I'm talking on the Option Insider networks. I have a lot going on, right? But I have some money hanging around that if you do, they're long-term contracts. So you're going to be locked in for a while. And you got to read the fine print, and you got to get someone that you trust. But they, they could invest long term for you. These are, hopefully, if you get a good, and you could really get a lot of good reviews on annuity providers. And if you find a good one, it's great. And you could stay in it for a long time, watch the fees. Be okay with being able to make a long-term investment, and then they could actually get into some pretty interesting investments that there's no way that you're going to be able to recreate on some of these things. So if you get with a good firm, understand what you're doing, they can be good things. And look at the cash flows, see if it matches what you need. Sometimes it's really good. I'm not talking about a lot of your portfolio, but again, 10 or 20% of your portfolio could be in something like that. 20 is probably too much, but 10%, and you have it there, forces you to save, forces you not to get at it for a while. So I'm not that negative on it. I'm actually somewhat positive for some people that that may not be able to put their investments and look at their investments all that much, Mark.
Wow! If you had told me that Mr. Matt from Oratz would be one of the few voices of reason or perhaps optimism when it comes to annuities, I would have expressed doubt on that, sir. But hey, there you go. Look at you, Mr. Matt, surprising me. I like it. You throw me a curveball here on the network. And you're right. For some people, you're right. I mentioned that at the top. They don't have the wherewithal or the time or the sophistication to do it. And if the big caveat is if they buy a good annuity, right? There's so many of these things are just snake oil. So if you could find the right quote unquote guaranteed income for life, it can play a role for you or for a lot of your clients who are maybe in that age and income bracket where something like this makes some sense. But you do have to do the due diligence. You really have to read the fine print, because so many of these it's like aluminum siding. Everyone's pitching it at you, and there's all sorts of snake oil being hucked at you. You have to really. So if you might think it's easier, just buy an annuity for your client, but the work comes in having to actually read the prospectus and figure out what the hell you're buying for your client. And so there's effort on either side. Again, it goes back to there's no free lunch in these markets. You have to put the effort in somewhere. It just depends on where you want to do it, or would you rather have set it up to do it yourself for your clients? Again, more work there, but perhaps a better return for the lion's share of your clients who don't fall into that small category that maybe are suitable for annuities. Let's end on this one, Matt, because it speaks to the theme of the show. This obviously came in earlier this year. We're just getting to it now. I apologize, Simon. Simon wants to know, do you think that the advisor role will become more or less important to trading in 2022 as we have more robo-advisors and free options content on the web and through social media? Well, yeah, Simon, we have seen quite the revolution, the democratization of options over the past couple of years, right? It is everywhere. There are people talking about options on TikTok. Who would have thought of such a thing just a year or two ago? But that's the world we live in now, let alone the Wall Street bets and the Reddit crowds and everything else out there. Our network obviously doing gangbusters numbers out there. So people are getting their options content in a lot of different ways. Does that disenfranchise the advisor? Perhaps. I mean, if you have a very self-directed client, then they've always been kind of a category unto themselves where they don't really rely as much on the advisor. You know, the advisor tends to work a lot more with the more passive income, more passive type of trading type crowd who don't want to spend their days knee deep in the markets, or perhaps they have other things going on in their lives or in their day job that prevents them from doing so. So that's always been a kind of a little bit of a different crowd for the advisor than the super active kind of self-managed client. They obviously have those too, but for a lot of those, they do prefer to be a little bit more DIY with that. And we have seen a growing element of that. So you can look at it both ways. You can also say, well, there's a growing audience of these people that maybe want to do it themselves. They want to kind of roll their own, DIY their accounts. But also there's a growing audience of people who are just more aware of the financial markets in general as a result of this. So if the old rising tide lifts all boats adage holds true, then even a small percentage of a larger pie is still going to accrete to a lot more business for advisors so far in 2022. Mr. Matt, where do you come down on this? Do you think that the advisor role become more or less important in 2022 in light of all these other developments we've seen, sir?
If you would have asked me this 2 years ago, I would have said there's so much information out here, educational things, it's a bull market. But now, bear market, very tactical market, a lot of moving parts, interest rates moving around. What's the Fed going to do? Michael Burry came out today in the Financial Advisor magazine, e-magazine, saying that the Fed might have a bullwhip effect where they might reverse rate increases. So, there's a lot going on out there. I think it's going to get, I think it's a lot more important to have a good advisor for part of your investments, at least now than, in any of the years since we've been doing this, at least, Mark. So I think that it's, again, it's a bear market. You can make some good tactical money in it. There's going to be some whipsaws. It's important to have, at least a good ear to help you out if you do a lot yourself, or someone that really understands the markets if you're not doing it yourself, Mark.
That's a good point. We are in a different market environment now than we were earlier in the year when this question came in. In a bull market, everyone thinks they can do it themselves. Everyone's a genius. You buy a call, the stock goes up, you're a genius. But now you're right, it is more tactical. So that could also reinforce the use case. So maybe for the second half here, the latter half of 2022, we will see a bit of a resurgence. Some of those folks who were more on the DIY side now switching to saying, maybe I do need a little bit of help with this. And so that could also work out in the advisor's favor. Either way, it does seem like we're seeing, and I'm going to be leaning towards more action on the advisor's front for the second half of 2022. Hit us up. Let us know if you have questions. Listeners, we got to as many as we could here on the show. There still are more. But don't worry. They come in and they're suitable for other shows. You don't think we're going to get to them on the advisor's option. We'll make sure you're answered somewhere else as well. So you will get your question answered, of course, if you want to bump to the top of the list. TheOptionsInsider.com/program. Another great pro Q&A coming up tomorrow with the one, the only, the short vol, and indeed Blackjack Hall of Famer, Mr. Don Schlesinger himself. That's always a fun one. Options Oddities on Friday. All the other good stuff we have scheduled for throughout the week. But before we go, Mr. Matt, if folks want to check out all the cool new stuff, and it sounds like it's a lot over there at ORATS, where should they go? What should they do?
Yeah, ORATS.com. It's going to be fun to get this earnings video out so they can learn a lot about our product and our front end, because we show a lot of screenshots on how to go find this information. And also, I think the biggest thing is going to be this 1 minute access to this data, where we're going to database all this, just a horrendous amount of data that you could access very easily if there are any programmers out there. JSON format and get at this information. You could follow an option, and just type in the Oprah, and it'll show you every minute where it was. So it's going to be just a crazy stuff that you can do now on the cloud, and we're going to be bringing it to you. So that's our big stuff at orats.com, Mark.
There you go. Check them out. orats.com. ORATS.com is the place to go. Give him a follow on the old Twitters as well. He's got a pretty memorable handle at Option Rats, and they're always tweeting out cool stuff in between episodes of the show. If you don't want to wait a month to hear from Mr. Matt, at Option Rats is the place to go in between episodes. And of course, you know where to go to learn more from our friends over there at OIC, optionseducation.org. You can go check out that collar study I mentioned. It's all there, and all the other studies they've done throughout the years. So if you want to arm yourself with a little bit more data when you're sitting down with your clients to talk about options, optionseducation.org is the place to go. We have to get on out of here. Back again tomorrow, like I said, for the pro Q&As out there, as well as for a live huddle with Mr. Overby from Ally Invest. So that's always fun. Don't get a chance to do those very often. Of course, TWIFO and the option block coming up later this week, and then options, oddities, and volatility views on Friday. Then we're back again. It's already July. It's crazy, with a whole new month and a whole new episode of The Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.